Hey, it's Mike Hambright with Flipner.com. Welcome back for another exciting VIP interview where I interview some of the most successful real estate investing experts and entrepreneurs in our industry to help you learn and grow. Today, I'm joined by my good friend Tim Herriage. Tim wears a lot of hats. A lot of you know him. He's a fellow Homevestors franchisee. He was the founder of the REI Expo, and now he's the managing director of B2R Finance, America's buy-to-rent lender. B2R actually happens to be one of our national sponsors. So Tim has a lot of experience buying and selling houses, and obviously B2R is very interested in the rental side of rental properties. There's a lot of interest in rental properties. Today we're going to discuss how to build a solid cash flowing rental portfolio. And while at B2R, Tim has looked at and they've analyzed portfolios of thousands and thousands of properties. So he's going to have some great information to share. So we're going to talk about how to build a solid cash flowing rental portfolio. Before we get started, though, let's take a moment to recognize our featured sponsors. RealtyMogul.com is an online marketplace for real estate investing, connecting borrowers and capital from accredited and institutional investors. Get a rehab loan fast and close in as little as 10 days. Rates start as low as 9%. We'd also like to thank National Real Estate Insurance Group, the nation's leading provider of insurance to the residential real estate investor market. From individual properties to large-scale investors, National Real Estate Insurance Group is ready to serve you. Please note, the views and opinions expressed by the individuals in this program do not necessarily reflect those of Flipner.com or any of its partners, advertisers, or affiliates. Please consult professionals before making any investment or tax decisions, as real estate investing can be risky. Yo, Tim, welcome to the show.
Mike, what's going on, bud?
Hey. There aren't very many people that I've had on twice, so this is your second round.
Well, I pull those strings, dude. You've known me too long.
Yeah. Well, we're obviously going to be talking. The first time we talked primarily about the expo and the importance of networking and things like that, and that was probably almost a year ago. So a lot of people kind of ask me all the time, how do you keep having? We've done. I don't know what your number is, Tim. People on the show will see it by the time this is airing, but over 170 shows in the past, 13, 14 months. So.
I've been impressed, Mike. I mean, it takes a lot of commitment to do the amount of interviews that you're putting out.
Yeah. Well, it's fun. It's great. Like you, I'm a social guy. I'm a networking fool, and it's been a lot of fun. So, hey, thanks for being back.
Yeah, man.
So, we were talking before the show about rental properties, and we talk obviously a lot about it. And I think, we've had a lot of guests on the show that talk about retailing and wholesaling and all sorts of other strategies. But you and I both know that most of us got in this for the ability to build long-term wealth and to, accumulate some rental properties, because those are the ones that keep paying us after we stop working.
That's right.
Yeah.
I mean, you look at me and you, I mean, we both, I guess if you added us up, we bought over 2,000 houses between the two of us. And while that's all fun and you have some big winners, you have some big losers.
Yeah.
Nobody likes to talk about the losers, but they're there every now and then. But that's a widget business, right? I mean, you buy it, you fix it, you sell it. You got to go buy, fix, and sell another to keep making money. And I think you and I both early in our careers realized you got to keep some. I always call it the richest man in Babylon principle, right? I mean, they say keep 10% of your earnings. I just like to keep 10% of my houses.
Yeah.
And it starts slow and then builds big, and it's definitely the exit strategy of working, because as you know, I mean, this is a business, and if you're fixing and flipping a lot, it becomes a full-time business. And you want to have an exit strategy out of any business. And to me, my rentals have always been the exit strategy.
Yep, absolutely. What's interesting is, you're more on the institutional side now with B2R, but you're kind of bridging the gap to the individual investor where there's a huge opportunity. And, if you listen to a lot, as you know, if you listen to a lot of the institutional guys, they refer to it as they've kind of discovered some new asset class that it's like you discovered a new continent on Earth or something. But the reality is a lot of people have known about it for a long time. They were just smaller mom and pops and individuals versus institutional players, right?
Yeah, I mean, it's funny. You finally said it. You said mom and pop, right? Because everybody, it's like if you read the newspaper, if you don't own 1,000 houses, you're a mom and pop.
Yeah, well,
and when you look at the real numbers behind the industry, there's over 15 million single-family rentals out there owned by nearly 8 million people. So that alone tells you that the quote unquote mom and pop are the mass market.
Yeah.
And, that's frankly why I'm at B2R we were the first ones really in the new institutional finance arena to reach out to the entrepreneurial type investors, the people that are frankly like you and I were when we got started, looking to build a retirement stream, looking to build long-term wealth, looking to have that exit strategy either out of their day job or out of their fixing and flipping business. And, it's been fun to help all the customers that we've helped in the last year. And, there's only up to go.
Yeah. Yeah. And maybe you could spread some light on a couple of myths out there, because I know there's a ton of people that own, 1, 2, 3 properties, but there really are a lot of people out there that own dozens or hundreds or even thousands of properties, and almost like their neighbor probably doesn't even know that, right? There's just a lot of kind of the millionaire next door type folks that own a lot of rentals and nobody knows it, and they like it that way. And,
So the big chunk of the 8-point-something million people that own rental property is people that own only 1 or 2. That makes up for nearly 50% of the market on a unit basis. But if you look at like the owner basis, 7 million of the 8 million actually only own 1. And Mike, and you've probably seen this so much in your home investors business too. A lot of times it starts off as they inherit mom's house, or they inherit their aunt's house, or they go buy it because it was down the street. And then all of a sudden they kind of realize, oh, this is kind of neat. I'm getting a check every month and it's free and clear. And then their CPA shows them that, oh, wow, you can write that off. That's neat. And, and then they start seeing, the tax advantages, and then they end up at a real estate club or watching your podcast, and they're like, okay, how can I get my next one?
Right.
And, frankly, that's where a lot of the problems start. Because if you're not a professional and you don't have a big track record, you really can't go to a bank. You can go to Fannie and Freddie, but, just frankly, the way the GSEs underwrite income and expense loads, it's more of a credit base than a cash flow base. And, I think that's been a big barrier of entry, and it's why if you look across, other countries, in Australia, 25% of all the mortgages that are originated actually are backed by investment property. In the UK, it's nearly 15%. In the US, it's like 6%.
Yeah.
And it's just, and that's why, really of those 15 million units out there of residential rentals, more than half of them actually have zero debt at all.
Wow. Yeah, that is definitely one problem with a lot of folks that we know that want rental properties, is even if they can get Fannie or Freddie money, they end up getting 4 or 10 or however many you're talking to, whatever the laws are that year. And then they're kind of maxed out, and they're like, nobody else, where do I go now? Where do I get financing at? And that's why they end up, probably why there's so many that are free and clear, because they've had to pay cash or use some kind of short-term bridge loan to get there. And that's where folks like B2R and stuff are coming into play now, right?
Yeah, and it's fun to really just talk to the customers and talk to the individual investors and hear the stories of why they're buying these houses. And where, it's funny, we had a guy in our office here in Charlotte today that has houses in Seattle, Charlotte, Houston, Dallas, and somewhere else up in the Midwest. And it's just like, and he lives in Seattle. And I asked him, I said, well, why not just buy in Seattle? Save yourself a headache. He's like, well, you really can't cash flow there. And the house price is so much, and they don't cash flow. He's like, then I started looking around, and he's like buying a 30-house package here in Charlotte, and he's got some private investors. And I like to ask, he's like, well, what are you going to do once you buy them? What's your exit strategy? And it's so many people. I tell you, it's got to be somewhere near 90% have this strategy of buying a bunch, getting them paid down, selling whatever they need to sell to pay off the rest, like you and I were just talking about, Mike.
Yeah.
And then owning them free and clear eventually, so that they can cash flow. And it's like an index-based annuity, right? Rents go up with inflation, which taxes go up with inflation, so it covers your margin there, and you can get that steady.
But there's no inflation in the U.S. right now.
Oh no, because you don't need gas or food or any of that.
Yeah.
Nobody up in the Northeast needs heating oil.
Yeah, right. So talk about, some of the lessons that you've learned, and maybe kind of give some advice here to people that are listening about, kind of the power of owning rental properties. There's going to be some people that listen to the show here that own a lot of rental properties, but they struggle with some of the financing things we're talking about. How do you get financing to make this make sense? But just, maybe share some lessons on the importance of proper financing. Let's start there to have a good rental portfolio that cash flows.
I think number one is rate really doesn't matter. Which, of course, that when you hear a lender say that, you're like, oh yeah, I'm sure it doesn't matter.
Right.
But it doesn't, right? Rate is a function of, how much leverage do you want? Because, right, if you're trying to get 80% leverage, well, then rate matters, right? If it's an amortized product. If you're trying to just get a 50% loan to value, rate really doesn't matter. I think what matters is what we've seen with the financing is, do you have the flexibility to grow your portfolio the way you want to grow it? And because everyone seems to invest when we meet the cash flow investors, we meet the speculative investors that are looking to buy at the trough, wait for some home price appreciation, and then sell and capture the capital gains instead of the ordinary income by it being a long-term investment.
Right.
And you meet people that have that trade between the two. And so the interesting thing is, one of the problems is, let's just talk about the problems with existing financing. As you know, with a bank, we probably use the same banks in Dallas, but if you were to go down to Houston, you probably can't use that same bank.
Right.
Or if you wanted to go to Kansas City, because J.D. Asbell up there, you can't use. You got to go meet his bank and try to, sell them on your business plan.
Right.
So that's just not scalable. Not even about scale, right? Let's don't use.
But a lot of these banks you're talking about, though, they're relationship based. That's why I have a relationship with my guys here, but in Kansas City, they don't know me from Adam.
Right, and and they get in and out of the market. It's really hard to figure out if they're going to lend, when they're going to lend.
Right.
And so it's not dependable. And so I think that's why I say rate doesn't matter. To me, what matters is you've got to have a financing partner that you feel like, when you pay cash, or you take hard money, or you use a line of credit to buy and rehab a house, that they're going to be there for you when you're ready to cash out, right? Because I think there's a lot of people that are creative. I've watched a lot of your podcasts. There's ways to go raise private money, borrow from someone's IRA, and all this other stuff. But if you don't have that dependable takeout financing to repay the debt or pay your credit cards back, I don't know about you, Mike. The first house my wife and I ever bought was actually on credit cards. We went down and did a bunch of cash advances and went and paid cash. But you can really do that for rental property if you know how you're going to pay that back.
Right.
So I think that's what's the most important thing is financing your rental portfolio. You just got to feel like your lender is going to be there for you.
Sure.
Right. They're not going to change the games in the middle of the road and leave you high and dry.
Yeah, and traditionally one of the other challenges people have is they may have a line of credit, but it's never big enough to kind of help meet their goals. A lot of these smaller community banks, right, they have maximums on what they can lend, and just by definition, when they're smaller community banks, the limits usually aren't all that high, right?
Right, and it's especially if you're relatively new or unseasoned.
Yeah.
Then it gets like smaller.
Yeah, right.
You could go into a bank in Dallas and probably get something completely different than someone that from the same bank, someone that is just 6-7 months into the business.
But I couldn't. At the beginning, nobody would talk to me.
That's right. Well, that's why I used to joke around that when we were talking to the home investors franchisees, is like, if you walk in and you tell the bank that you want to buy rental property and they ask you why, you just need to get up and leave, because that's the wrong bank to talk to, right?
Yeah.
They don't get that why you want to buy it. You got to go find a different loan officer, right?
Yep.
I think the other thing that we've learned is people, like, one of the number one things people are looking for is guidance, is checklists and best practices, and I think that's why shows like this are great, because there's just a wealth of free information, and whether it's by downloading the podcast or some of the things you've talked about you're going to do soon, it's people are looking for information because what we learn is they they get bit by the real estate bug. And they want to get in and invest and own their own future. And I think that if you can provide some education, so like some things people miss, property management. I think you've had a couple shows on property management here recently.
For sure, yeah.
I mean, when I started rental property, I self-managed. Lord, it was a glorious day the day the last tenant moved out that had my cell phone number. I mean, did you self-manage when you started?
No, not at all. But we were more involved. I mean, we had a property manager, but we seemed to get pulled in on everything. And I kind of learned enough to know that, we didn't want to do that. We actually did manage. We had a small multifamily out of state at one point that we sold off pretty quickly because we realized it's just a nightmare. That's not what we wanted to do. But same thing. We had people that had our cell phone numbers and, come to you because a light bulb's out, and it's crazy. But
it's always like Friday at 7:00 when you're sitting down to dinner with Lindsay and
yeah. Hey, maybe talk about some of those things because a lot of people that are interested in rental properties, you and I both know. Back to this education part, they hear the sexy part of it. Oh, I can deduct depreciation from my taxes. I can shelter income. It cash flows. Someday it'll be paid off. But what they don't think about, and nobody, even people that are trying to sell them products, what they never talk about is you're going to have fun managing that one, or the property management part. When a bank kind of pulls your line and says, we're going to take that money, you're going to have to refinance these or sell them or do something. I'll kind of talk about some of the nasty side that really never gets talked about.
Well, so I think the number one thing people miss is vacancy. Tenants don't live. If you have a 7-year plan, tenants don't buy into that plan and say, okay, we'll stay here for 7 years till you sell the house, Mike.
Right.
On average, they move out every 1.8 years, I believe, is the number from the National Association of Realtors. And depending on the different neighborhoods and whether it's a transient neighborhood or what we found is even like if it's a 2-bedroom, 1-bath, right? The vacancy's higher on that than a 3-bedroom, 2-bath.
Right.
It's just when you're looking at it, right, and when you're looking at the cash flow and does it meet your goals, I'd say that's probably the number one thing that people don't budget in is vacancy. Lost rent over a 2-year period.
Yeah.
The next would be maintenance because a lot of people, they even think that if they go in and they spend extra money on the initial rehab, or if they buy a brand new home from a home builder, that they won't have the repair bills that other people that you have on like a 1950s house that wasn't completely renovated. While some of that is true, the example I always use to a customer when I'm talking about what we call capital expenditures, things that you're going to spend no matter what. If you own a rent house in the state of Texas, the air conditioner, with about a 99% certainty, I can guarantee you're going to replace that condenser in a 10-year period.
Sure.
Right?
Oh, yeah.
It's even if it's brand new. Because people that don't own a home just don't take care of it the way. Well, frankly, I'll say that if you owned it, you should. You and I both know in the ugly house business that even people that should don't take care of things the way they should. So maintenance and repairs is another big thing people miss.
I think those things they're so true. Especially the make ready cost when you lose a tenant, right? It's not just the vacancy. Well, now it's vacant again. It's like they probably, you're going to have to go in and do some work. There's nothing worse than, we had a house that we totally rehabbed, spent like $25,000 on the rehab. It was like a brand new house inside. We had a tenant there for 4 months, and they did $7,000 in damage, and we took 2 months to evict them. That stuff sucks, right?
Yeah, and if you're not looking at that going in, when it happens, it just makes you more likely to say, forget this.
Yeah.
I'm not going to be a landlord. Never mind. This doesn't work. The guy that sold me this course or this house or this book or, that TV show I watched, they're just a bunch of liars. And the truth is it does work. You just have to, you've just got to plan for things that are going to happen. It's funny. That's the example, right? It's just like flipping houses out with our franchisees and home investors. I always say the worst thing that can happen is for someone to hit a big profit on their first house.
Yeah.
And the same thing holds true with the worst thing that can happen with a rent house is the first tenant stays for 12 months, gives you a 30-day notice. They move out, and it's only $500. You just clean the carpets and have the house clean, right? Because that does happen. It does happen sometimes. But there's also the 4-month, $7,000 example. Which, frankly, Mike, is interesting because it's a lot like if you really look at what Fannie Mae and Freddie Mac and the GSEs have done by stopping you at 4 or 10, they've almost put most people in more of a position to fail. Because when you only have 4 houses, if one goes vacant, you're at a 25% vacancy on your income. Right? If you've got 20 houses and one goes vacant, you don't even notice it. Right? You're 95% occupancy. You've got excess cash flow that's paying for the rehab, that's paying for the other mortgages. So what I say is, and what I believe, is the quicker you're able to cycle your capital and add more to the pool, the less you notice the problems.
Yeah, because you can weather the storm. I mean, for every house that you have somebody that tears it up and you have some turnover issues, you've got houses that somebody is there for 4 or 5 years, never asks for anything, rents on time like clockwork, and it kind of offsets that, right?
Yeah, and then it just comes down to, and that's like, so number one, that's why I think it's great to have a property manager, because I use the example like if you own stock in Walmart, right? That's an investment. And if Walmart was planning to sell Tide for $3 a bottle and had to sell it for $2.75, they don't call you about it as a shareholder, right? They just sell the Tide for what they need to sell it for. And the same thing goes with the property manager, right? I mean, you and I actually use the same guy a lot of times. I mean, you don't want the phone call about the light bulb. You don't need the phone call about cleaning the carpet. You don't need the phone call about, frankly, with the size of portfolio that I have now and you have now, you don't even need a phone call about the eviction, right? It's just evict them, rehab it, get it released, send me my monthly report.
Right.
And so I think that, when you really look at it, the best way for someone to be successful in this business is to build a well-balanced portfolio that cash flows as quick as possible, because it's going to mitigate your risk. And then, if you have if you have 2 vacancies in a 6-month time period, and one's the 7,000 and one's the 500, I mean, just by economies of scale, you've offset the damages that you're going to have to pay as an investor.
Yeah. What are your thoughts on? I always tell people that I don't even know if I say it differently depending on who they are. I pretty much tell people that I don't think they should ever manage their own rental properties, because most of the people that I'm talking to, they have an opportunity cost of doing something else with that time, right? Any thoughts on, a lot of the folks that you look at, do they tend to be, after they have a portfolio over a certain size, they get a property manager, or are they more likely to bring it in-house as they scale up? Or?
It's kind of funny, actually. The biggest portfolios that we see actually are more likely to have professional management.
Yeah.
Because there's a bit of an entrepreneurial spirit behind this, so people want to do it all themselves. And one of our employees at B2R just bought his first rent house, and he's self-managing it. And it's all the horror stories you hear about. Oh, this regulation, that regulation, are just completely avoidable if you just pay someone that's a licensed professional to do the job for you. And it's kind of the same thing I say about everything, right? It's if you're an attorney, you should spend your time being an attorney.
Right.
If you're a professional property manager, you should spend your time being a property manager. If you're a licensed general contractor, you should spend your time being a general contractor. And so it's like, if you're an attorney and you're spending your weekend cleaning out a house and painting it, I don't know. I mean, you can do that, and if it's a bad market or you're having a bad month, that's one of the beautiful things about rent houses is you actually do have the opportunity to get in there and put some elbow grease behind the investment, and it truly does save you money. But I don't think it should be part of your business model. If that's not what you do for a living.
Yeah, I mean, that time in your example of an attorney, if they're billing at $200 an hour or something, it's like, well, just work 5 hours, billable hours on the weekend, and have a property manager take care of that for you. Everybody, I think that's the biggest thing that I see with people that own rental properties is And really, real estate investing across the board is they don't really consider their opportunity cost of what else they could be doing with their time, including enjoying their time with their family or doing anything else. I mean, what is that worth to you versus saving a few bucks to manage yourself?
And then the other part of that, like you're saying, is so true, because also, if you're not involved in the blow-by-blow, if you don't know every single thing that goes wrong and you just kind of get the high-level summary, I feel like you're less likely to be discouraged or to, have any disenchantment with the opportunity. I think you can, if you're not like, oh my God, the paint cost 3 times as much. It's like, okay, but wait, that's really only $90 extra. So
right.
How does that, if you're not involved at that level, then I think that you're able to look at the big picture, which, this is a big picture thing. I tell people all the time. I mean, if you're buying rent houses, it's a retirement account. It's not flipping, right? It's not invest now, profit next month.
Right.
It is make the investment over 3 to 5 years, and then you can look at it and it will be something significant.
Yeah.
And I think the example I use a lot is if you contribute to the 401k where you work, you don't expect to live off that money next month.
Right.
And a rent house is the same thing.
Yeah. Yeah. Well, maybe you could share some thoughts on, there's, 2 really kind of major strategies that people focus on in terms of financing. The ones that want to keep their houses levered up as much as they can forever and generate more cash flow now, or the strategy that I have, which having a financial background, this doesn't seem to make a lot of sense on its face, but just getting the damn things paid off as quickly as I can. And so, I mean, those are kind of the 2 main strategies you see probably most people in, right? I want to get them paid off as quickly as I can, or I don't care if I ever pay them off because financing is so cheap that I just want to leverage it forever.
Yeah, I mean, I think it would almost be like a financial advising exercise, right? It's when you look at which stock to buy. Is it the high risk, high reward, which I would call maintaining a 70% leverage on a portfolio and not paying it down? Or is it the low risk, low reward, right? I mean, your returns are not going to be as high if you pay them off, but there's an end date, right? I mean, and I have the same strategy as you, Mike, right?
Yeah.
I mean, it's get leverage, sometimes realign your leverage, specifically if there's opportunities out there. Right now, inventory's kind of tight. So we have a lot of customers that are coming to us, getting us teed up so that when they find the opportunities, then they can refi, pull their money out, and go reinvest.
Yeah.
We have a lot of people. I think a lot of our customers are actually refinancing to pay off private lenders or hard money lenders or banks so that they can then go recycle that capital and then come back to us for another takeout. Then, it's kind of the wash, rinse, repeat approach.
Right.
Freeing up other capital.
Yeah. Well, hey, Tim, we've only got a few minutes left here. I know we could probably talk all day about this. Sometimes we do, actually. But tell us for a few minutes about B2R, and thank you for the sponsorship of the show. I mean, I think it's funny that I don't say this because we have a relationship, but I think that the type of product that B2R offers to people that want to own rental properties is probably the best product out there. And for a lot of folks that aren't familiar with it, they need to check it out. And it's one of those things where most people hit a wall with using their local banks or trying to use Fannie and Freddie type money, certainly private money. You're going to hit a wall at some point. So I think that you guys have built a great product, and the rates are great. I mean, the terms are really great and appealing to a lot of real estate investors. It wasn't that long ago that you and I were, being pitched by somebody of how 10% in 1 point makes sense on rental properties, and the term adjusted it was a balloon every 3 years. It's like they were talking about how great that was, and I thought that was nuts, but obviously something much better has come along. But just take a few minutes and tell us about kind of B2R and what you guys are doing, how you're benefiting property owners.
High level, and then I just encourage anyone that's interested, even if you don't have properties yet, go to flipnerd.com/B2R, get the phone number, call us, and just talk to one of my account executives here in Charlotte to walk you through the program and how we can help you. But high level, if it's a single family, multifamily, condo, townhome, duplex, 2 to 4 unit, Basically, if it's a residential rental property that someone pays rent on to live there, except for you or your family, we'll finance that property for you based off of the property's cash flow, not your personal income, right? Because I joke around, if you're actually doing this the right way as an individual investor, you should look like the brokest millionaire to the IRS. And so we don't look at your tax returns, right? Because you should be taking your interest deductions and your depreciation and everything, every expensable item you can. So we look at the cash flow of the property, the debt service coverage ratio, which is almost like a debt to income. So it's like, if the property's making $500 a month in cash flow after all the maintenance, management, repairs, taxes, insurance, and any homeowners associations, we'll give you a loan where the payment is $400, right? Because if your principal and interest is $400 and your net cash flow is $500, awesome. We know that you can pay us.
Right.
On our portfolio product, the loan amounts $300,000 is the minimum. So you have to have 5 leased units. So like a deal that we did today was 3 duplexes in Oklahoma City, right? So that has 6 leased units, so it qualifies. They were, 130, 140,000. I think they're like 150 appraised value. So I think the loan amount's like 350,000. And this investor had full cash out, so he had paid all cash for the houses. So he's looking at, we do have some minimum FICOs. I mean, you have to have like, I don't know, it's a 660 or above on your, if you don't, you can go non-recourse, and then that's a whole different product.
Right.
Loans up to 75 loan to value. Cash out is allowed and encouraged. After you've owned the property for 90 days. So after 90 days, we just go off the appraised value of the home. We do full appraisals, and then we'll give you cash out based off of that. Right now, we're only offering loans on the 5 units or more, the portfolio loan, where it's in. Oh, and by the way, it's in a company name. So one of the other things we didn't talk about this, Fannie and Freddie make you do it all in your personal name, right, which is asinine with regards to asset.
Yeah, and then you feel like you're being sneaky to go deed it over to another company, and
so they're all in the name of a corporation of your choosing, and an LLC preferably, and then it's just a blanket mortgage. We're very soon, most likely March, April, rolling back out our one home, one loan program.
Wow.
We tested that in fourth quarter. And one of the things about our company is we're big on customer service, and we're big on under promising and over delivering. So we tested it. We're readjusting internally. Probably go through another beta round in March, April. Be full bore on that by the summer. We are close to offering lines of credit to investors that want to fix and flip, or even buy and hold, or even what they call temp to perm, a bridge to perm product.
Yeah.
We're going to continue to morph and move for the market because there's here's some quick stats. I know you got to wrap up. Last year there were 5.5 million residential sales. Of those 5.5 million residential sales, 1.1 million were investor transactions. So if you look at that at $130,000 per transaction, which was the average, that's $143 billion worth of real estate sales.
Wow.
And 53% got financing, so that's $74 billion.
Wow.
So we know the market's huge, and we know that if we treat customers right, they'll be customers for life. And that's our focus, and we're going to continue to develop products to meet the demand, because the demand's there. And I am personally available for anyone that has, if there's any concerns. It's a very high touch, as you know. I take pride in what I do.
Yeah.
And, if someone has a problem with my company or a question that can't get answered, they're more than welcome to reach out to me direct. My email's on the website.
Awesome. Well, Tim, thanks for joining us today. For anybody interested, check out. We'll add a link down below, but you can go to make it simple for you, flipnerd.com/B2R. And there are really some great products if you want to refinance your rentals, or you're looking to grow your rental properties, or even looking to cash out to buy more properties, any of those things. So a lot of folks are really happy with B2R, and Since I know Tim personally, I know that he takes this very seriously, as he just said. So, Tim, thanks again for joining us today, buddy.
Thanks, Mike. Good to see you.
I'm sure I'll see you soon, my friend. Are you a member of FlipNerd.com, the most robust real estate investing platform in existence, where you can find off-market wholesale deals and great vendors literally in your market? You can get access to advice from experts and learn about local clubs and events right in your backyard. If not, please visit FlipNerd.com and register for a free account. You can register in less than a minute. It's pretty much the coolest site that's ever existed in the real estate investing industry, so get on over to FlipNerd.com.